And thank you for joining us today in the Entrust Group's webinar. What you need to know about the Secure Act. This course is mainly going to be addressing the effects of the Secure Act for IRAs as well as individual 401k plans. Although there are changes under the Secure Act that affects 401k plans in general, we're going to reserve those and set that aside. We're going to focus mainly on IRAs and individual 401k plans. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Before we get started, the Entrust Group does not provide investment advice or endorse any products. All information and materials are for education purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. I had to say that disclaimer just to make sure that everybody knows that this is not offering tax advice or legal advice. This is just basically for educational purposes to keep you aware of what's going on legislatively that could affect your IRAs and or individual 401k plans. Now, again, the goal of this company, the Entrust Group, the company basically has a goal and focus on education. The more educated our clients are, or the more aware you are with the changes are in legislation, what opportunities are out there, we believe that you can make a better decision. All right. So without further ado, let's just go ahead and dive into the material. First, we'll talk a little bit about the Entrust Group for those of you who are attending some of our seminars for the first time. We're going to talk about the benefits of a self-directed IRA, benefits of self-direction, because that's basically what we have as our platform and our niche is self-directed IRAs. And then we're going to dive into the Secure Act of 2019. And then we'll talk about how to get started with the Entrust Group if you don't already have an IRA at the Entrust Group or an individual 401k plan with the Entrust Group. And then we're going to open up the phones for any questions you may have in regards to the material. So I'm going to devote about 40 minutes of the hour that we have to the presentation of the material, and I'll try to move along as in a good steady pace for you. So if you have any questions, please jot your questions down. And hopefully we can answer all of your questions since it is a new piece of legislation. There are a lot of issues that still have yet to be answered, but there are some good things that have occurred with the Secure Act of 2019 that may benefit some of you who are listening today in this particular webinar. The Entrust Group has been around nearly 40 years. We administer over 22,000 accounts with over $3.3 billion in assets. The main delineator of the Entrust Group are the tools that we have to support our clients in the self-directed world. Mainly, one of which is we have people that you can actually speak with. We have a customer service department in our Oakland office, as well as strategic brick and mortar offices in some parts of the country, some in the West Coast, East Coast, as well as the Midwest. That allows for you to be able to talk to individuals instead of recorded lines, so on and so forth. We actually have trained individuals that could guide you through the rules, not to give you advice, but present you the rules so you can make an informed decision. Not only do we educate the Entrust Group employees, but we also educate the industry. We are an approved provider for a few of the designations out there, or some of the major designations out there, including but not limited to the CFP board. We are an approved continuing education provider for the Internal Revenue Service, as well as the National Association of State Board of Accountancy. So those are some of the major ones that we offer CPE, Continuing Professional Education Credits, as well as we offer, we drop ship some of our individuals or consultants to be able to educate, industry professionals such as practitioners, attorneys, CPAs, and investment advisors in regards to the benefits of having a retirement plan as well as self-direction. And I myself is the founder and writer of what we call the IRA Academy. The IRA Academy is a four-day training course that prepares individuals for what we call the CISP designation, the Certified IRA Services Professional designation. That is a designation through the American Banking Association's professional certifications. Many individuals in the industry, including but not limited to banks, credit unions, broker-dealers, trust companies, have this particular designation since it's such an accredited designation, and our school helps prepare individuals to take that particular exam or that designation. And our school is approved by the American Banking Association. Now let's dive into what is the benefit of a self-directed IRA before we get into the Secure Act. A self-directed IRA is not any different than any other IRA that you have out there. It does follow the same rules as any other IRA that you would establish at a bank, credit union, broker-dealer, trust company, so on and so forth. But unlike other financial institutions that offer the investments that they sell, the Entrust Group, as a self-directed IRA administrator, does not sell any investments. But instead, we sell the necessary platform or necessary components to be able to, number one, establish a retirement plan with the Entrust Group, and number two, the infrastructure to support alternative types of investments to be held under your retirement plan. So in other words, we offer the document, we offer the custody services through a trust company, an affiliate of ours, which is a completely separate company, to create the checks and balance with our administration as well as the custody services. Our trust company is out of Nashville, Tennessee, chartered in the state of Tennessee and regulated by the state of Tennessee. And that's the entity that will basically, that gives us the authority to custody the assets that are held under your Entrust IRA. From there, we allow for greater diversification because we allow for you, the taxpayer, to choose the investment that you have that's, of course, allowable by law and does not have any conflict of interest, in other words, prohibited transactions, to hold under your retirement plan. It will still maintain the same tax-deferred growth, just like any other IRA, and will be, either taxed upon distribution, such a traditional IRA, or tax-free in the event that it's a Roth IRA and you've satisfied certain criteria. This is an alternative means of diversifying your portfolio beyond stocks, bonds, and mutual funds. Although those are good investments, you can personally look for an investment and approach us to be able to hold that particular investment under your Entrust IRA. Some investments, common investments that are held under a self-directed account are real estate, notes, precious metals, certain precious metals that are allowed to be held under an IRA, as well as private placements. So in other words, if you have an investment that will not be administered by some financial institution, well, our open architecture platform can basically have a discussion with you to determine whether or not we can hold that under the Entrust Group. So for the most part, unless it's a life insurance contract or a collectible or an S Corp, chances are, as long as there's no conflict of interest, it can be held under the Entrust Group's self-directed IRA platform. Now, we're not limited to self-directed IRAs, as mentioned earlier. We also offer what we call individual 401k plans. Individual 401k plans are designed for employers to have a 401k plan, and one of the main features is the fact that the employer must not have any rank-and-file employees. The reason why we administer these accounts is because we don't have to perform the non-discrimination tests typical 401k plans would have to run because there's no rank-and-file employees. However, if you are an employer and you do have rank-and-file employees, there are other small business plans that are available to be held under the Entrust Group, such as your Simplified Employee Pension Plan or your SEPs, as well as your Savings Incentive Match plans called your SIMPLE, that looks like a 401k plan but also does not have the non-discrimination tests that have to be run on a yearly basis, because in lieu of having to run those tests, employers must make mandatory contributions, but they can have rank-and-file employees as part of the plan, or in other words, eligible to participate in the plan. In a self-directed account, however, the contributions can be invested in anything you wish, except for life insurance contracts, collectibles, and S Corps. With that open ocean of investments available out there, it's up to you, the IRA holder or the retirement plan holder's responsibility to do your due diligence on your investment. Since the Entrust Group does not offer that investment, you're the one that seeks out the investment. We highly recommend that you seek your competent tax, legal, or investment advisor in performing your due diligence before you enter into any transaction. That's why we always say we just try to educate on the general rules, but it's really up to you to make that decision in the long run. So if you need some expertise, we highly recommend that you seek the assistance of competent tax, legal, or investment advisor, because the Entrust Group does not offer legal, tax, or investment advice because we're not licensed to do that. All we have the license to do is to be able to custody your asset and offer the retirement plan. Here are the benefits of self-direction. You take control of your investment choices. You're not limited to the investments that are being offered by the financial institution. As well as, with that in mind, you can diversify more broadly, your investments in your retirement plan portfolio. And last but not least, the different types of retirement plans has its own tax savings. And that's why we're going to be covering the SECURE Act to take a look at what those rules are and what has changed that affects the retirement plans that you currently hold today. Again, the contributions may be tax deductible, but eventually be taxed. And those are your traditional types of accounts. And last but not least, if you want tax redistributions without the tax deduction, and then there's another type of IRA called a Roth IRA or a designated Roth account in a 401k plan, where you could actually enjoy tax deferred growth, but eventually distribute those earnings tax-free. Now let's dive into the SECURE Act. Enough of the Entrust Group. All right. I know a lot of you are attending this particular seminar to find out more about the SECURE Act. On December 20th of 2019, President Trump signed into law what Congress presented to him, the Further Retirement Consolidations Appropriations Act, or FCAA, which contained another piece of legislation called the Setting Every Community Up for Retirement Enhancement Act of 2019, called the SECURE Act. Under the SECURE Act, there are some notable changes to IRAs and individual 401k plans that we will be covering today in this particular seminar. And the provisions of that particular tax law, was effective January 1st of 2020. Some are beneficial, some are not so beneficial, but let's take a look at what those are. All right, starting off with here we go. The treatment of a certain taxable non-tuition fellowship and stipend payments, compensation for IRA purposes. What does that mean? Certain individuals, let's say they're in graduate school, and they receive a stipend, which is a non-tuition fellowship payment, and those assets, if used for, let's say, living expenses or whatever it may be, that's helping them out towards their postdoctoral or graduate studies. Those assets are typically non-taxable if used for qualified expenses. However, for the amounts that are not used for qualified expenses, those are taxable to the individual. Now, in the past, those dollars were not able to be used as earned income in determining whether or not they can contribute to an IRA, because those dollars are typically not subject to what we call FICA and FUTA. In other words, they're not received for services performed. In other words, they're not wages for services performed. Even though it's taxable, it's not considered as wages for services performed. Well, the SECURE Act, with the passage of the SECURE Act signed into law, passed by both houses, the House of Representatives as well as the Senate, with minimal changes, signed by President Trump, those assets are not going to be considered compensation for contribution purposes, even though it's technically not considered as earned income. Earned income, the safe harbor definition of earned income are W-2 wages. In other words, when you receive a W-2 for wages that you receive from services you perform for the calendar year, that's what we call earned income. Certain income called passive income, such as rental income, dividends, interest, those are great income because it's not subject to Social Security tax. This is one of those types of incomes only affecting a select group of individuals that are receiving maybe taxable income because it wasn't used for qualified expenses. Those can now be used, even though it's not technically earned income, to make contributions to a retirement plan. They deserve a retirement plan too. That's what Congress says. Again, amounts not used for qualified expenses that are taxable to the individual, even though they're technically not earned income, may be used as the basis or compensation to determine the amount of contribution that they can make to a traditional or Roth IRA starting in 2020. However, keep in mind the limitations are still depending upon the amount of income that they receive will determine the amount that they can make as a contribution. For example, if the maximum contribution in 2020 is $6,000 to both a traditional IRA and or Roth combined, in other words, you can put any variations of contributions to a traditional IRA and a Roth IRA as long as the combined total does not exceed that one limit of $6,000, plus an additional $1,000, of course, if you're age 50 or over, which totals to $7,000 if you are age 50 and over. You still cannot get to that amount if your earned income is way less than that. In other words, if your income, let's say in this case, your taxable non-tuition fellowship and stipend payment is $2,500, even though it can be used as a basis of determining eligibility to make a contribution, you still cannot make a $6,000 contribution or $7,000 if you're 50 or over. You're still limited to the amount of your income for the year. However, if you have other sources of income that would put you to that $6,000 or $7,000, depending upon how old you are, well, then, that this is good for you. Then you could basically make a contribution and use this income as the basis of making a contribution for a particular year. Again, if you have any questions, please jot your questions down, and we're gonna do our best to answer all of your questions within the time frame that we've allotted. All right. Treating excluded difficulty of care payments as compensation for determining retirement plan contributions. Now, for some of you who may not have this type of income, there is what we call difficulty of care income that is under Section 131 of the Internal Revenue Code. And there's a particular definition of what we call difficulty of care income under that section of the code 131. And that's basically for foster care purposes. In other words, foster care income. According to the according to a notice 2014-7, if this affects you, and for example, one of our clients basically has an extended care facility as an example, and if there's some of the people that they're taking care of foster care, they might want to take a look at this and see if they qualify. Of course, check with your competent tax or legal advisor. So if you want to find out what is the definition of difficulty of care, there's a notice. Just Google it. Notice 2014-7. Basically, it defines what is difficulty of care payments. Okay. As a matter of fact, in that notice, the prologue or the first part, it says this notice provides that certain payments received by an individual care provider under a state Medicaid home and community-based services waiver Medicare waiver program described in this notice are difficulty of care payments excludable under Section 131 of the Internal Revenue Code. Now, I'm not going to go through extensively on what that means, but it's good to find out what's the benefit of that, right? These non-taxable income that are received under Section 131 of the Code typically cannot be used as earned income for contributing to IRAs and other types of retirement plans, given the fact that it's non-taxable. And this income may also not be subject to FICA and FUTA. Again, check with your tax advisor. If it's not subject to FICA and FUTA, it's not earned income. It's called passive income. Therefore, that income received may not be used for contributing to retirement plans, defined contribution plans, as well as IRAs. Now, these individuals that are doing this are maybe this is their career, their heart career. In other words, it's a career that they chose because that's what their heart wants to do. It's a very difficult task sometimes, taking care of individuals that people normally, have a hard time taking care of. Congress wanted to give relief by waiving the taxation of those types of incomes. However, they were not considered as earned income for contributing to a retirement plan in the past. Well, the good news is moving forward, these individuals can now use that amount as as not earned income, but compensation for purposes of contributing into a defined contribution plan, such as your individual 401k plan, your SEP plan, your simple plan, as well as if you have enough money, they can still contribute to an IRA, whether it be traditional, Roth, so on and so forth. So, in other words, these individuals, that are receiving non-taxable income deserve a retirement plan too. Section 131A says excludes qualified foster care payments from the gross income of the foster care providers. One of the main stipulations on this notice 2014-7. Now, I'm not going to go again into great detail, but at least you know the direction of where you need to go to determine that to determine whether or not that income can be used for contribution purposes. Now, keep in mind that's strategic and that's significant, because an individual can contribute up to the lesser of 25% of compensation up to a certain dollar figure, as an example, to a SEP plan, a self-employed, a simplified employee pension plan. That's a lot of money to be able to shelter into a retirement plan, whereas those dollars were not as eligible to be contributed in the past. And once contributed to the retirement plan, of course, those dollars can be used to self-direct or invest in an investment that you've chosen under the Entrust Group platform, such as houses, notes, private placements, whatever it may be, tax liens. Those are the common types of investments held underneath our retirement plans in the self-directed world. But you can also invest in stocks, bonds, mutual funds. It just may be in another financial institution, CDs, money market accounts. Those are traditional types of investments. Moving forward, this type of income can now be used for contribution purposes. Again, that's notice 2014-7. Another significant thing that was included in the Secure Act is the repeal of the maximum age for making traditional IRA contributions. Whereas in the past, the moment a person reaches age 70 and a half, to be specific, it's the year in which an individual reaches 70 and a half, they can no longer contribute for any time during that year to a traditional IRA. And some of our clients that actually hold pieces of real estate that would like to add money into their IRA because they need cash to pay for expenses such as mortgage insurance, or whether it be the asset under their IRA for property taxes or any other expenses that the IRA may incur, they could not put money in because they could no longer make contributions. Well, the good news is, starting in 2020, you can, as long as you still satisfy some of the other rules that are still in place, that you must have earned income. And last but not least, the deductibility rules still remain in place. If you're covered by an employer-sponsored plan, depending upon your income for the year will determine the amount that you can use of that contribution as a tax deduction. In other words, that amount can be used to reduce your taxable income for the year. But the good news is, again, the maximum age for making traditional IRA contributions has been repealed. In other words, there's no more age limit to making a traditional IRA contribution. Now, why are we talking about the Roth? Because the Roth has always had no age restriction. So for both the traditional and the Roth, there's no more age restrictions to make a contribution to your traditional IRA account, right? Another good news is that for individuals who are of required minimum distribution age. Mainly the past, we talked about the age 70 and a half. The year in which a person turns 70 and a half is going to have to start taking a minimum distributions. In other words, a small amount to deplete that account. Well, that age 70 and a half, beginning January 1st, 2020, will only apply to individuals who have reached age 72. However, let me caveat that with this, that if you've already turned 70 and a half prior to 2002, well, this new rule does not apply to you. In other words, you must continue to take required minimum distributions. If you turn 70 and a half in 2019 or older than 70 and a half in 2019, this rule does not apply to you. So in other words, even though in 2020, an individual who turned 70 and a half in 2019 may only be 71, they still would have to take a required minimum distribution, because this is only in effect for individuals that are turning 70 and a half in 2020. If you're turning age 70 and a half in 2020, you can postpone your first required minimum distribution in the year that you turn 72. So you get a little bit of a break. Another thing that is not included in the Secure Act that you might want to know is that the IRS has issued new life expectancies that is used to calculate required minimum distributions. And mainly when I looked at the new life expectancy tables, the average increase in life expectancy is up to 2 years. You know what that means? It will further reduce the amount of RMDs for individuals that are needing to take required minimum distributions, because people are living longer. President Trump asked the Treasury Department to update the life expectancy tables, and we got it. Unfortunately, the new life expectancy tables is not effective until, at least at this point, tax year 2021. So in other words, the changes are, if you're turning 70 and a half in 2020, well, you can postpone your RMD until the year in which you reach age 72. However, if you already started taking required minimum distributions, in other words, you turned 70 and a half in 2019, well, you cannot postpone your RMD because the tax law did not take effect until 2002. You will still have to take a distribution by at the latest April 1st of 2020, with a second one on December 31st of 2020, if an individual decided to postpone their first RMD until April 1st of the year following the year in which they were required to take a required minimum distributions. Now, what they don't talk about here, but I'm going to talk about anyway, is the fact that the age 70 and a half is tied to what we call qualified charitable distributions. Qualified charitable distributions allows a taxpayer to take a taxable distribution and donate $100,000 directly to charity. And that amount, as long as it's donated directly to charity, will not be subject to taxation. A lot of individuals have accumulated a lot of wealth in their retirement plans, and they just want to donate that to charity. There are limitations on what you can use as a tax deduction if assets are donated to charity. That's why this is significant. This came about during Katrina, where a lot of people who are over 70 and a half are saying, I really don't need this money. I'd like to give this to on the efforts to support Katrina victims. But their tax advisor says, don't do that, because your distribution will be taxable. And they're saying, why? Because you can only deduct up to a certain percentage of your income for the year for charitable contributions. Well, Congress responded with what we call a qualified charitable distribution, which now, instead of a charitable deduction, this actually is specific to the age 70 and a half, which that age is codified under the tax law. In other words, even though the mandatory distribution has been increased to 72, qualified charitable distributions are still available for individuals who are age 70 and a half, because it is not tied to the required minimum distribution rules. Even though a person who's age 70 and a half in 2002 is not required to take a required minimum distribution until they reach age 72, they can still take a distribution up to $100,000 for qualified charitable distribution purposes as we speak, unless, of course, the IRS reconciles the two different tax laws together, which they don't have the authority, because it's only Congress that can change the tax law, because it is part of the Internal Revenue Code, right? So individuals who have started taking RMDs are required to continue taking RMDs, and as long as, because they're not, the new rule does not apply to them. Again, if you have any questions, please jot your questions down, all right? Here's an additional thing that they included in the Secure Act and the tax law, that individuals may take a distribution of up to $5,000 for qualified birth and adoption expenses. In other words, if you're going to adopt somebody, or if you as a couple, you're going to have a birth, you can take up to $5,000 a piece. In other words, up to $10,000 for the couple from your retirement plans. And it'll be penalty free if it's used for qualified birth or adoption. Now, of course, in order for that to be valid, the child's name and tax identification number must appear on the individual's tax return 1 year from the date of birth or when the adoption is finalized. The term adoptee means any individual other than the child of the taxpayer spouse who has not attained age 18 or is physically or mentally incapable of self-support. So in other words, for different abled children that people don't want to adopt, if you adopt them, regardless of, as long as, they're not attained age 18 or physically or mentally incapable of support, they qualify to be adopted, and you will be exempt from a penalty if you take a distribution from your 401k plan, 403b, governmental 457b, or your IRA. Now keep in mind, some people may say, well, what if I'm still working? Well, it would be viewed as if you can take a distribution, even though you have not reached what we call one of the triggers or distributable event from a 401k plan, because that's also included in the tax law. Check with your plan sponsor or employer if you are wanting to take a $5,000 distribution towards birth or adoption expenses, and that amount will be exempt from the penalty. Now, what if you don't use some of the assets that you've distributed for qualified birth or adoption expenses? Well, Uncle Sam says you can roll it over as long as it's within the 60-day period. Now, when you take a distribution from a retirement plan, typically the withholding from, for example, a qualified retirement plan, 403b or governmental 457b is 20%. This amount, according to the tax law, will be subject to the 10% withholding amount. In other words, setting aside a portion towards the taxes that you would owe. To put it in perspective, this is only a penalty-free exemption. It's not tax exemption. So in other words, you'll still be subject to the tax for this distribution, but will be exempt from the penalty. The 10% withholding can be waived by the taxpayer upon distribution, so pay close attention to that. So if you want to take a $5,000 distribution and you want the full $5,000, you may want to waive out of the withholding requirement of 10% that the payer must withhold and send to Uncle Sam. So in other words, whether it be a qualified retirement plan or an IRA, pay close attention to the withholding form that is provided to you by your employer or the custodian of your IRA. And if you want the full amount, you might want to waive out of the withholding. And again, any assets that you don't use, you can roll back as long as it's within the $5,000 amount or the amount that's within the expenses that have been incurred for qualified birth or adoption expenses. But the maximum is $5,000. All right. Another modification, which is kind of detrimental for tax planning strategies, is the elimination of the life expectancy option for beneficiaries. Let me give you a brief overview of that. If an individual passes away prior to December 31st, or in other words, January 1st of 2020, if an individual passed away prior to January 1st of 2020, beneficiaries of an IRA or a qualified retirement plan or a 457b plan or a 403b plan had the option to deplete their account in small increments called life expectancy payments. The way that is calculated is you take the previous year's balance and divide it by the life expectancy of an individual. Now let's focus on that thing called life expectancy. From a strategical perspective, the younger the person is, the smaller incremental distribution to deplete that account would be. What if you named a 21-year-old or an 18-year-old or 17-year-old? In other words, an individual beneficiary could prolong the taxation of the account that they've inherited for a long period of time, because the younger they are, the longer the life expectancy. Now, that was something that Congress wanted to address, because those dollars in retirement plans have never been taxed before. There's over $27 trillion, and don't get bogged down on the numbers because it changes on a regular basis. But what that tells you is that there's a lot of money in retirement plans, and Congress wants those dollars to be taxed sooner than later. Why? Because the governments need the cash for tax. The tax we pay still is still the amount that is used to run the government, to offset certain benefits that are provided or tax cuts provided in the past, as well as under other pieces of legislation this is one of the ways for them to be able to pay for it. And who are we talking about that could be affected? Well, if you're an individual and you fall under the baby boomer category between, in other words, you're born between 1946 and 64, there's 78 million of you. And about 10,000 of you are turning 60 every day. In other words, you're not old, but you're not getting any younger either. So therefore, a lot of people are saying, you know what, let me plan on how those accounts should be distributed upon my death so that my beneficiaries can reduce the amount of taxation. Well, the modification to these rules will change the options available to a beneficiary for individuals who pass away beginning tax year 2020. However, if an individual passed away before tax year 2020, the old rules still apply. Those beneficiaries technically still have the life expectancy option. But for the most part, moving forward, beneficiaries who are not exempt beneficiaries will no longer have the life expectancy option, but instead, they will be forced to deplete the account in a period of 10 years. In other words, the year that contains the 10th anniversary of the IRA holder's death. There are exemptions, however, to this particular rule. Here are the exemptions from the 10-year rule. Number one, the IRA holder's spouse. The spouse can still prolong the taxation of what they've inherited based on their life expectancy. If a beneficiary named is less than 10 years younger, they can also still continue the life expectancy option. A chronically ill beneficiary will also be able to postpone taxation by using life expectancy payments. In other words, as a means of reducing the amount that must be distributed on a yearly basis. And last but not least, a beneficiary who has not reached the age of majority. And in some states, it's 18, and in some states, it's age 19. And I believe in Mississippi, it's 21. So in other words, in some states, the age of majority, in other words, legal age, is age 18. But there are 3 different states, I believe, that have a different age of majority. And that's Alabama, that's 19, Mississippi, 21, Nebraska, 19. In other words, they can take life expectancy payments. In other words, if a person passes away, they left it to a 5-year-old, they can still continue to take life expectancy payment until that 5-year-old reaches age 18, if that's the age of majority, or 19, if that's the age of majority, or 21, if that's the age of majority. And then from there, it will revert to the 10-year options. In other words, they have 10 years to deplete that particular account. Now, when we start taking a look at the chronically ill beneficiary, there is under statute definitions of that, and that will be something that you should discuss with your tax or legal advisor as part of your estate planning process. Why is that? Because that could potentially stretch out the taxation on behalf of your beneficiary that may produce a level of income that they could receive for the rest of their life, because they're not subject to the 10-year rule. Another one are beneficiaries who may be what we call disabled under Section 72M of the Code. In other words, they can no longer work. So those individuals may also continue the life expectancy payments based on Section 72M of the Internal Revenue Code. Again, we're not going to cover in great detail who's chronically ill and who's disabled, but know that there's some consultation that must occur with you and your tax, legal, or estate planner to determine maybe some options that you might want to take a look at to increase the opportunity for you to stretch out the payments for your beneficiaries upon your death. There are still some outstanding issues that need to be clarified by the Treasury Department. As an example, what if a trust beneficiary is named? We typically use the oldest beneficiary for life expectancy purposes. If the trust beneficiary is let's say a non-spouse beneficiary, because keep in mind spouses are, automatically have the life expectancy option. If we have a non-spouse beneficiary and let's say the non-spouse beneficiary is less than 10 years younger, do they still get the life expectancy option if there are other beneficiaries within that account? Another thing is that what if there's multiple beneficiaries named in an IRA, which a lot of people have, which by the way is a good reason to check out your beneficiary designation forms to make sure proper estate planning is done based on by operation of law. Your beneficiary designation will determine who your beneficiary is. If there's multiple beneficiaries, we typically use the oldest one. However, does that nullify the life expectancy option if a beneficiary less than 10 years younger is named by virtue of the fact that there are other beneficiaries named in that account? If separate accounting is done, in other words, they would be viewed as if they were independently named if separate accounting is established in a timely fashion, which is December 31st of the year following year of death. If those separate accounts are established on behalf of the beneficiaries, does that mean each beneficiary gets to have their own option? Those are still outstanding issues that we're waiting for the IRS to address. However, again, the typical option for a IRA holder spouse is still the life expectancy option based on the spouse's life expectancy option. A beneficiary less than 10 years younger can still use the life expectancy option. A chronically ill beneficiary and or a disabled beneficiary can still maintain the life expectancy option. And last but not least, a beneficiary who has not reached age of majority, in other words, of legal age, they can still maintain the life expectancy option, but will revert to the 10-year rule. In other words, they have to deplete their account within 10 years upon reaching age of majority. All right. Again, if you have any questions, jot your questions down, and I'll be more than happy to answer your questions as soon as we finish the presentation. This is the plans adopted by the filing due date tax year may be treated as in effect as a close of the year is a significant change, beneficial for individuals that want to establish an individual 401k plan. Individual 401k plans are attractive for employers to be able to shelter more assets as a tax deduction from their business income by contributing to an employer-sponsored plan. Because 401k plans not only have the profit-sharing contribution, they also have the deferral contribution to extend the amount or the limit that they can actually shelter as a retirement plan contribution in their own retirement plan. Now, 401k plans typically have a deadline of the end of the fiscal tax year to establish the plan in order for them to have a plan for that particular fiscal tax year. And if it's a calendar year plan, January 1st to December 31st. If it's not established by December 31st, they cannot make a contribution to that plan for that particular tax year. Although the contribution is due until the tax return due date plus extensions of an employer, the establishment of the plan must still happen by December 31st. Now, this does not apply to SEP plans because SEP plans can be established up until the tax return due date plus extensions of an employer. In the past, 401k plans, in this case, individual 401k plans who are designed for owners only, cannot establish an individual 401k plan after the end of their fiscal tax year. Well, this changes the ballgame. Because according to this particular rule, if you're an individual 401k plan, you don't have to sign your document, or in other words, establish your plan until your tax return due date plus extensions. That's significant. Why is that? Because some employers, self-employed individuals, partnerships, whatever it may be, may not even know if they have income for the year to determine what type of plan they want to establish. If you're going to establish a plan, you don't even know if you had income for the year. It's kind of a cart before the horse. To parallel the two, in other words, to sync the two up, Congress basically says for individual 401k plans, you can wait up until your tax return due date plus extensions to make a contribution. Now, we're talking about individual 401k plans here, but let's take a look at a glimpse of a snapshot of an employer that actually has employees. If you have employees, well, how can you establish an employer-sponsored plan by your tax return due date plus extensions when the deferrals of employees actually come from their W-2 wage? In other words, wages that they've already received. That's still a question that the IRS still is grappling over to come up with some sort of guidance for us. But mainly for individual 401k plans, since these individual 401k plan employers are typically sometimes self-employed. In other words, even if it's an LLC, if there's just one of you, you file your taxes using a Schedule C. Or if you are a partnership, then you get a K1. Well, you can actually establish and make a contribution to your individual 401k plan, a newly established individual 401k plan, until your tax return due date plus extensions. Again, that's significant. Check with your tax advisor. Now we're getting towards the end of this presentation, and then we're going to answer your questions the moment we get to that section. As an incentive for employers to establish an employer-sponsored plan, Congress basically has an incentive for small employers, meaning employers with less than 100 employees who earn $5,000 in the preceding year. In other words, a small plan. They must have at least one rank-and-file employee. So this particular benefit does not apply to owner-only plans. You must have at least one rank-and-file employee, and it must be a newly established plan. In other words, you must not have had any other employer plan 3 years prior to establishing this plan. You can receive a tax credit for establishing an employer-sponsored plan with a greater of $500 or $250 for every rank-and-file employee that you have, capped at $5,000. That's a pretty substantial tax credit for those employers, small employers, as an incentive to establish a plan. The employer may take a credit up to 3 years, Congress says, under this new rule. It used to be you can take up to a tax credit of $500, which is up to 50% of your first $1,000 of expenses. They've literally thrown that out and increased it to the greater of $500, flat five. Doesn't have to be based out of expenses. Or number two, $250 for every rank and file employee. So in other words, if you have 10 of them, that's $2,500. Or if you have more than that, then it's capped at $5,000. And the employer may take a credit for up to 3 years. This is a great incentive for small employers to establish a small business plan. Now, going back to the tax increase for startups, there is also an additional incentive for employers, as an example, who may have established a simple IRA program, which has a deferral piece. In other words, money being taken out of an employee's paycheck. If that simple plan has what we call an automatic contribution arrangement, in other words, let's say you have an employee, employee, you're eligible to participate in this plan. You can either defer, a percentage or an amount of your paycheck, capped, of course, up to a certain dollar figure. But if you don't respond on whether or not you want to participate or not, in other words, you're not responsive, I will automatically take out a certain percentage out of your paycheck. That arrangement right there is what we call an automatic contribution arrangement. An additional amount may be used as a tax credit above and beyond what we talked about right now for employers that adopt what we call an automatic contribution arrangement. And in the IRA world, that would only be what you call your simple IRA program, right? So if you have a simple IRA program as an employer and you adopt the automatic contribution arrangement, well, guess what? You can get an additional tax credit. Now, for some plans, such as what we call your individual 401k plans that must file additional filings, such as what we call the IRS Form 5500, the moment the assets of the plan reaches $250,000 or more, the fees or the penalties per day has gone up. Right? The fee used to be $25 per day for late filing of the IRS Form 5500, which is due by the end of the 7th month following the plan year. In other words, the end of July in its calendar year plan. For every day that the IRS Form 5500 is late, it's $25 per day. In the past, it's gone up to $250 now per day because employers are failing to file that form. Now, complementary to that, the Department of Labor will also assess a 401k employer trustee, or however you want to call it, an additional penalty for failure to file this particular form called the IRS Form 5500. And their fee is $1,100 per day. So in other words, along with the IRS, the Department of Labor combined can actually penalize an employer up to a lot of money per day by failing to file the IRS Form 5500 because of this increase from $25 to $250 per day, right? Now, again, a small employer automatic enrollment credit, an additional $500 tax credit can be awarded to an employer if they adopt an automatic contribution arrangement feature. And in this case, if it's IRAs that we're talking about, it's called simple IRA plans. All right. Now that we're done with that, if you don't have an IRA or an individual 401k plan at the Entrust Group, it's easiest 3 steps. Open up an Entrust account with us, fund your account, and last but not least, instruct us to purchase your asset. Now I've gone through a little bit over my 40-minute time frame, but I will open up the phones for any questions you may have in regards to the material presented. Again, if you have any questions, please give us your questions. All right. Here's a question that we have. The life expectancy option, I'm hoping I understand this. IRA in 10 years starting this year? The answer is yes. In other words, if for deaths that occur starting in 2020, which means if somebody passed away in 2019, this new rule does not apply. You still get the old rules. In other words, you have life expectancy payment options. But if somebody dies starting 2020 moving forward, the life expectancy option is no longer available for beneficiaries that are not exempt beneficiaries. In other words, does not fall under the exemption. If they're a spouse, they're exempt. If they're a beneficiary less than 10 years younger, they're exempt. If they're chronically ill or disabled, they're exempt. If they're a minor that has not reached age of majority, they're exempt until they reach age of majority, then they revert to the 10-year rule. Any other non-spouse beneficiaries, so in other words, if you name your child, which is 25 years younger than you, and you die, well, if you die 2020 moving forward, well, they have 10 years to deplete the account that they've inherited. That is, it's still 10 years, but this will apply to both not only traditional IRAs, but also Roth IRAs. So if, again, if an individual has, a large amount of assets in their retirement plans, it may be good to talk to your competent estate planner or tax advisor to determine maybe additional steps that you might want to do for estate planning purposes to be able to reduce or defray taxation longer for your beneficiaries. Now, with the additional, let's see if we have okay, here we go. Let me hang in there, folks, having a little bit of technical difficulties seeing the questions that I am being asked at this point. All right, here we go. There are quite a few questions. Okay. This is good. This is good. With the RMD age being moved to 72, does that mean I cannot get the tax advantage of giving my RMD to charity until age 72? I wanted to start doing that at age 70 and a half. Must I not wait? The answer is no, you don't have to wait because the age 70 and a half is not tied to the age 72 for RMD purposes. So if you're 70 and a half, you want to start giving to a charity, you can still do so because that again, is not the qualified charitable distribution criteria is not tied to the 72 RMD age. All right. I hope that answers your question. For an existing beneficiary IRA, when does a 10-year complete withdrawal? Fragmented question. Okay, for existing beneficiary IRA, when is a 10-year complete withdrawal? Again, if you're talking about a beneficiary account for a person who died prior to 2020, the 10-year rule does not apply. However, if a person dies in 2020 and the beneficiary is subject to the 10-year rule, the 10th year is the year that contains the 10th anniversary of the IRA holder's death. So in other words, if a person dies in 2020, start counting. 2021 is the first year, 2022, 23, 24, 25, 26, 27, 28, 29, 2030. 2030 will be the end of the 10-year rule. So in other words, in 2030, everything must be depleted out of that account. Since it is an RMD, any amounts that are not distributed will be subject to the RMD penalty under Section Internal Revenue Code 4974, which is 50%. That's why it's good to be for IRA holders to talk to their beneficiaries that they name in our IRA, so that they're prepared on what they could choose or what their options are on taxation, as well as how to defray taxation for, in this case, 10 years. Or talk to your competent tax or estate planner on the best way to be able to reduce or minimize the amount of taxation that could be incurred based on an amount that an individual inherits. Right? How can you avoid the monthly fee or cancel the self-directed if I don't quite understand the question, so I'm just going to go move on ahead. I mean, if it's an Entrust fee, you might just want to give us a call on our 800 number if it goes beyond this particular seminar. All right. How does this 10-year rule affect the inheritance of a Roth IRA? I added that to that because the question just says, how does this affect an inheritance of a Roth IRA? Well, it does affect the inheritance of a Roth IRA because the 10-year rule also applies to Roth IRA beneficiaries. So in other words, instead of having the life expectancy option available for everybody, the life expectancy option is only limited to the ones that qualify for the exception. If they don't qualify for the exception, the 10-year rule applies. They must deplete the Roth inherited account in 10 years. I hope that answers your question. How can you avoid the monthly fee or cancel the self-directed IRA if needed? Again, give us a call if you have any questions on that. Question: my Entrust Roth and IRA own a rental property jointly. At 70.5, can the rental income residuals still be put into the account as long as the IRA distributions are met on other accounts? Well, don't quite understand what you're getting at, but this is how I will answer that. Rental income received by retirement plans are put in as if it was interest. As a matter of fact, rental income is what we call passive income, rents and royalties. So those amounts can be placed into the Entrust account, not as contributions, but just as interest received proportionately based on the investor, which is either the Roth or traditional. So if there's $1,000 of income, 50-50, $500 goes to the Roth, $500 goes to the traditional. Now, if a person reaches age 72, all right, in this case prospectively, because keep in mind, if you're 70.5, then you're in RMD stage already. If you reach 72, or 70.5 in 2020, which you can postpone into 72, the Roth IRA account does not have any RMDs. However, the traditional IRA has required minimum distributions. So therefore, whatever the proportionate share is in the traditional will be subject to required minimum distributions when a person reaches age 70.5. Although the balance in a Roth will not be subject to the required minimum distribution rules. Now, a strategy some people do is to avoid having to take a required minimum distribution, they convert their traditional IRA to a Roth IRA. In other words, pay the tax on whatever amount they want to put in a Roth IRA in a particular calendar year. It's includable in taxable income, by the way. However, the amounts in the Roth will now not be subject to required minimum distribution rules. So I hope I answered that question for you. Incomes that are received by an investment is not considered as contribution, but in this sense, it's considered as earnings. And if it goes to a traditional IRA and a person is 70.5 last year or 72 prospectively, that IRA will now be subject to required minimum distributions. Will the email we receive of the recording also include a copy of the slide set? And okay, that will be something that we can address outside of this particular seminar. All right. I have an inherited IRA from my parent. I'm currently 72 and in good health. Do I now have to deplete that IRA in 10 years, starting this year? If your parent died, to answer your question, if your parent died prior to 2020, you still have the life expectancy option. However, if your parent died in 2020 and you're greater than 10 years younger from your parent and you're not chronically ill, disabled, then you must deplete that account within 10 years. I hope that answers your question. What is the maximum contribution to a simple IRA for a small business owner? And where can I go get the IRA related estate planning advice? Well, hopefully any estate planner who's keeping themselves aware of the retirement rules would be a best place to go. And if they have any questions on retirement plans, we'd be more than happy to sit in on a call with your estate planner to answer any of the retirement plan questions they may have, but we can only answer general rules. We cannot answer your specific situation, but in conjunction with your competent tax or legal advisor or estate planner, we can answer some of the general rules involved in regards to estate planning with your IRA. Now, when it comes to the maximum contribution to a simple IRA, you can go to publication 560 of the Internal Revenue Service, and publication 560 will talk about the 3 different types of retirement plans. And that's what you call your SEP, your simple, and individual 401k plan. And the maximum contribution for the year can be found in that particular publication. Okay. Next question. For the 10-year beneficiary rule, can one make their grandchild as a beneficiary? The answer would be sure, but the grandchild, upon your death, would have to deplete that account. Based on their life expectancy, if they have not reached age of majority, but will revert to the 10-year rule at the moment they reach age of majority. So if you name your grandchild who's 5 years old and the age of majority is 18, your grandchild can still take life expectancy options for 13 years, because that's the difference between 18 and 5. And then from there, your grandchild will have an additional 10 years to deplete that account the moment they reach age of majority. All right, I hope that answers your question. I assume that interest and dividend income is considered earned income. Dividend and interest income is not considered earned income. It's what we call passive income. Interest and dividend income is not subject to Social Security tax. That's one of the biggest delineators. W-2 income is subject to Social Security tax. As a matter of fact, if it's the FICA and FUTA, that's what we're talking about. That's why a lot of entrepreneurs like passive income, rental income, interest income, dividend income, because it's what we call passive income. However, Congress says you can't double dip. We're not taxing that income for Social Security taxes because we're not considering it as wages. Therefore, we also cannot consider that income as earned income. W-2 wages are the only, W-2 wages, which include your self-employment income. In other words, your Schedule C income, if you're a self-employed individual, and or incomes on a K-1 for a partnership that are considered earned income. Line 14 in the K-1 of a partnership, IRS Form 1065, maybe one of the things you might want to discuss with your tax advisor to determine whether or not you have earned income. And the reason why I say that is because some partners are silent partners. They don't really perform any services for the company. Therefore, they don't draw a paycheck. So if they don't draw a paycheck, they don't have earned income. But it's best discussed with your tax advisor to determine if you have earned income. So I hope that answers your question. Right. If a parent dies in 2020, moving forward, do their children have only 10 years to liquidate the assets? Yes, they do, unless the child is less than 10 years younger, or unless the child has not reached age of majority. If they have not reached age of majority, they can wait for until the year in which that child reaches age of majority, and then at that point it reverts to the 10-year rule. At least that's the way we understand it today, right? Hope that answers your question. If I donate directly from my IRA, does that donate count as part of my RMD and is also non-taxable? If it's for qualified charitable distributions, the answer is yes. Qualified charitable distributions count towards your required minimum distribution. And if it is given to the qualified charitable institution, it is non-taxable up to $100,000 per taxpayer. Now I'm going to take your answer further. How do I tell the IRS that it's for qualified charitable distributions? Well, on your IRS Form 1040, there's line 4A and 4B. 4A discusses distributions from retirement plans. And of course, the IRS knows that only up to $100,000 is excluded for qualified charitable contribution purposes. In aggregate, in other words, combined total of all distributions taken from all retirement plans that are taxable must be included on line 4A. So that's how you cap it at $100,000. On line 4B asks what amount of this distribution is taxable. And that's where the IRS says, if you used it for qualified charitable distributions, write the acronym QCD, qualified charitable distribution. And then the IRS will deduct up to $100,000 per taxpayer. In other words, if it's a couple, then it's up to $200,000, right? And then from that perspective, the distribution will be exempt from taxation. So to answer your question, does it count towards your RMD? Yes, if you are already taking RMDs. And number two, is it non-taxable if it's given to charity? The answer is yes, up to $100,000. How do you report it? Line 4A and 4B of your 1040, your individual tax return. Check with your tax advisor on that one. Again, I hope I answered your question. For the 10-year beneficiary rule, can one make their grandchild as their beneficiary? The answer is absolutely. Absolutely. And again, as the other questions, answer the other questions, it will be life expectancy payments until the year in which the grandchild reaches age of majority. And then at that point, it will revert to the 10-year rule. All right. Do these rules apply to cash distributions to beneficiaries, or does it include property bought with an IRA or S Corp? Number one, S Corps cannot be an investment under an IRA. An IRA that includes properties, it just means that your IRA does not have cash, but instead it's properties. So do these distribution rules still apply to them? Yes, it's the same exact rules that applies to a self-directed account as applies to other IRAs out there. They're all subject to the same tax law. All right? What was the number of the paper that explains the three different types of IRS mentioned a few moments ago? I'm not quite sure what you mean by that. But anyway, if you could explain further for us what that question means, then I will answer that question. Hopefully answer that question if I understand the question correctly. If my children are of different ages, one having reached adult age and the other one not, then the one who reach adult age will have to withdraw their share. Do parents have to specify how much each child receives? Well, let's take a step back. The starting point on what options beneficiaries typically have stems from the beneficiary designation form. The beneficiary designation form is one of the most incomplete, sometimes vague forms that we receive at the Entrust Group from individual IRA holders. In a nutshell, if you want to make sure that your assets go to the rightful heirs, make sure that your beneficiary designation form is completed properly. Not only do you put the name, you must put the relationship of the beneficiary, and as well as include as many pieces of information in that beneficiary designation form that allows for the custodian to be able to contact your beneficiaries upon your death. Half of the time, we do not have social security numbers. We don't have telephone numbers, email address, or even addresses, telephone numbers for the beneficiaries, that upon the death of the IRA holder, there's no one for the Entrust Group to contact to notify the beneficiary that they've named in their IRA. Number two, each beneficiary may be assigned a proportionate share, but the aggregate total of the shares must equal 100. All right. I've seen beneficiary designation forms where the percentage is not equal 100. That's problematic as well. If beneficiaries are not named in the Entrust IRA document, the default beneficiary is an individual's estate. It's not good news in most cases because, number one, if the estate is the beneficiary, the estate becomes public record. In other words, it's available to the public to look at. Creditors, scrupulous creditors, may try to get a portion of the assets of your estate, which goes beyond the scope of what the Entrust Group does, because now it's in the probate court. So what's the moral of the story? Name a beneficiary. You can name beneficiaries as individuals. You can name beneficiaries as entities, such as charitable institutions, but make sure you provide the ample information for the custodian to be able to contact your beneficiaries. Number two, to answer your question, you must assign a specific number of or percentage that each beneficiary must receive. One of the outstanding questions that has not been answered by the Internal Revenue Service is that if there are multiple beneficiaries, do they each get their own options that they could choose from? Why is that important? What if one of your beneficiaries is a sister that is less than 10 years younger? And of course, a sister, it can take life expectancy payments because it's less than 10 years younger. And if you also name your children as beneficiaries, well, generally the rules state that the oldest beneficiary will be used to determine the distribution, the minimum amount that must be distributed out of each individual account as the basis of calculating that one amount that is separated based on the percentages allotted for each beneficiary. So if it's two beneficiaries, a sister and a son, well, then the older beneficiary must be used to calculate the small distribution, but each individual must distribute their proportionate share, 50-50. Another rule says that if separate accounts, in other words, inherited IRA accounts, are established by December 31st of the year following the year of death, they could be viewed as if they were independently named. In other words, it's as if you took separate IRAs and named each one of them independently, which could be beneficial for the youngest one. Why is that? Because what if your 10-year-old was named as the beneficiary? According to the rules, the 10-year-old can use life expectancy payments until they reach age of majority, and it will revert to 10 years. They can postpone the depletion of that account for a longer period of time. Whereas, let's say a 35-year-old son may not have that life expectancy option, and they must deplete that account within 10 years. So really, a lot of variations based on the old rules and applying the new rules need to be answered by the Internal Revenue Service to determine, number one, do these old rules still apply to this particular situation? And if so, what are the strategies involved on how to delay taxation further in an application of the new rules? So to answer again your question, does the parents have to specify how much each child should receive? The answer is in the beneficiary designation form, yes. If not, it'll be equally divided. And if you have 3 children, please give one of them 34%, your favorite one. Why is that? Because it's hard to deal with fractional shares. In other words, you don't want to do 33.333. It gets problematic there too. And then whose age would you use for the withdrawal? If the separate accounting is currently right now, if the separate accounting is done by December 31st, each individual has their own option. However, if separate accounting is not done, then we revert to the oldest beneficiary in that particular account, according to the current rules. I gave you a mouthful of information. That's really a complete course that we actually even provided towards the end of the year. Please attend that course so you could find a little bit more information, more detailed information in regards to your question. Is the QCD only on required minimum distribution, or can I use this as a tax deduction once I reach 59 and a half and start withdrawals to give to my church? Well, if you're 59 and a half, you do not qualify for the qualified charitable distributions because this only applies to individuals who have attained age 70 and a half. However, distributions from IRAs can be donated to the church, and that amount will be will be includable as taxable income, but offset with your contribution as a charitable contribution to the church, assuming that you do not exceed certain thresholds that can allow for you to use that distribution as a tax deduction. So in other words, let me give you the general parameters. Typically, the general parameters, you can only deduct up to 50% of your income for the year. That's what determines the threshold of what you can use as a tax deduction. Let me give you an example. Let's say somebody's 59 and a half, they make $60,000 a year. 50% of that is $30,000. If you take an IRA distribution and it doesn't qualify for qualified charitable distribution, and you take a distribution of $100,000, now you didn't just make $60,000, you made $160,000. And then from there, you have to take 50% of that as a general rule, $80,000, and then you can only deduct up to $80,000 of that distribution. That's a simplistic calculation, but it's a little bit more complicated than that. But I just wanted to relate that concept. Qualified charitable distributions, again, only apply to individuals who have attained age 70 and a half, not 59 and a half. But you can still take a distribution upon attainment of 59 and a half. It is still includable in taxable income, but as far as the amount that you can use as a tax deduction will be determined by your income for the year. All right. A mouthful again. Another question. Can a non-spouse beneficiary wait until the 10th year to disburse the total IRA, or do they have to withdraw a percentage every year? That's a good question. Do they have to incrementally split the balance and distribute a small amount and distribute it in 10-year increments for the 10 years? The answer is no. They can wait up until the 10th year. And if it's a taxable account, Congress actually likes that, because the higher your taxable income for the year, it may fall under a higher income bracket. Therefore, it could be taxed higher. So careful planning on what they should do should be discussed with a competent tax or legal advisor. So in other words, for example, if it's $100,000, 10 years, $10,000 every year may be beneficial for the beneficiary to do that, because their taxable income for the year will only increase by that amount that they distribute. Whereas if they wait until the 10th year, that $100,000 distributed at that point will be includable in taxable income, which may fall in a higher marginal tax rate. So again, additional tax planning, consultation, coordination between you, estate planner, your beneficiaries, tax or legal advisor is highly recommended to determine the implications of what an individual may be inheriting. Is it tax-free, or just, or is it, if it's a Roth IRA, it's all tax-free, right? So eventually, once you've had a Roth for 5 years and you pass away, the beneficiaries will enjoy that amount tax-free. So in this case, they could wait for the 10th year, but if it's going to be a taxed amount, you might want to consult with a tax advisor. Well, I think our time has run out, but if you do have more questions, please give us a call. I'll be more than happy to answer your questions for you. I hope you enjoyed today's seminar, and I hope to have you again in another Entrust Group seminar. Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. You can give me a call if you have any questions, or email me, and love to be able to respond to your question or refer you to the right place where you can find your answer. We hope to have you again soon in another Entrust Group webinar. Thank you again for attending, and have a great day.